What's going on, everyone? We have a filing out of FINRA to talk about today. This is SR-FINRA-2022-007, and this is to increase the position and exercise limits for conventional options on certain exchange-traded funds, or ETFs. Now, the purpose of this one, FINRA Rule 2360 B3A imposes a position limit on the number of equity options contracts in each class on the same side of the market that can be held or written by a member, a person associated with a member, or a customer or a group of customers acting in concert. Position limits are intended to prevent the establishment of options positions that can be used to manipulate or disrupt the underlying market, or might create incentives to manipulate or disrupt the underlying market so as to benefit the options position. In addition, position limits serve to reduce the potential for disruption of the options market itself, especially in illiquid option classes. This consideration has been balanced by the concern that the limits not be established at levels that are so low as to discourage participation in the options market by institutions and other investors with substantial hedging needs, or to prevent specialists and market makers from adequately meeting their obligations to maintain a fair and orderly market. Rule 2360 B3AI does not independently establish a position limit for standardized equity options. Rather, the position limit established by the rules of an options exchange for a particular equity option is the applicable position limit for purposes of that rule. Rule 2360 B3A paragraph 3 provides that conventional equity options are subject to a basic position limit of 25,000 contracts or a higher tier for conventional option contracts on securities that underlie exchange-traded options, qualifying for such higher tier as determined by the rules of the options exchanges. In addition, FINRA lists position limits for options on securities that have higher position limits. Currently, only the ETFs listed in Rule 2360 B3A paragraph 3A6 that also generally mirror the options exchange position limits. At this time, FINRA proposes to conform its conventional options position limits to the SIBO exchange recent amendments that increase the position limit options due to an ongoing increase in demand in options on the following ETFs. So this is basically what we're getting to as far as the bulk of the filing. The ETFs in reference here are the iShares IBOXX Investment Grade Corporate Bond ETF, or LQD. And then we have the Van Eck Vectors Gold Miners ETF, or GDX. Together, the underlying ETFs referred to in this filing. Now, the proposed change, basically, they would add to the table provided in Rule 2360 as follows, with the effect of each ETF being increased from the current position limit of 250,000 contracts. They're going to be doubling that. So basically, the LQD and GDX are both going to be doubled to 500,000 contract position limits. And the reasoning for this, as far as creation and redemption for ETFs, FINRA believes that the creation and redemption process for ETFs subject to this proposed rule change will lessen the potential for manipulative activity with options on the underlying ETFs. Regarding ETFs, when an ETF provider wants to create more shares, it looks to an authorized participant, generally a market maker or other large financial institution, to acquire the securities the ETF is to hold. For instance, when an ETF is designed to track performance of an index, the authorized participant can purchase all of the constituent securities in the exact same weight as the index, then deliver those shares to the ETF provider. In exchange, the ETF provider gives the authorized participant a block of equally valued ETF shares on a one-for-one fair value basis. And this is important. The price is based on the NAV, or the net asset value, not the market value at which the ETF is trading. So it's based on the net asset value, not the market value. So that's important. The creation of new ETF units can be conducted during an entire trading day and is not subject to position limits. This process works in reverse, where the ETF provider seeks to decrease the number of shares that are available to trade. And that's how they're controlling everything, through ETF creation and redemption. So as far as surveillance and reporting, I didn't even copy that paragraph over. Surveillance and reporting. Finally, FINRA believes that the current financial requirements imposed by FINRA and by the Commission adequately address financial responsibility. Concerns that a member or its customer will maintain an inordinately large unhedged position in any option with a higher position limit. Current margin and risk-based haircut methodologies serve to limit the size of positions maintained by any one account by increasing the margin or capital that a member must maintain for a large position. So basically, fostering more responsibility. So they say. I don't know how doubling the size of your limit would increase responsibility, but that's what they're saying. So basically, those IBOXX and the other ETF mentioned, the VanEck, will be doubled in position limit size. And as far as effective date, this will become effective immediately. FINRA has filed this rule change for immediate effectiveness and has requested that the SEC waive the requirement that the proposed rule change not become operative for 30 days after the date of filing. So typically 30 days is what you're looking at before anything can become approved on a standard filing. But since this is immediate, FINRA is wanting to implement this right now. So it should be in effect as of tomorrow. And if you want to learn more about this kind of stuff, or you want to join a trading community that is doing very well, we have a website, footstoptrading.com. Very cheap entry. Most members make a year's worth of membership in their first trade. Take it easy.